This is Wall Street Week. I'm David Weston, bringing you stories of capitalism. This week, as luxury brands fight to regain their momentum, does a secondary market help or hurt? And what the facts show about deregulation and its effect on growth and productivity. Plus, when a so-called zombie company can come back from the living dead, we tell you the story of the return of Barnes & Noble. But we start with the story of true conflict, when the approach of the largest country in the world seems at odds with the fifth largest economy. When President Trump met with Indian Prime Minister Modi earlier this month, the tone was cordial. But it was a step back from the so-called bromance that started in Trump's first term. And what the two men said were their core interests appeared to be in true conflict.
I will very simply put America first.
Make in India, make for the globe.
Until now, the India growth story has been one of the biggest of the post-pandemic world. Its growth rate touched 8%. Its benchmark stock index, the Nifty 50, has outpaced the S&P 500 since the start of 2021, at least until recently.
The shine has come off the India story a bit over the last few months. The stock market's fallen quite a bit over the last few months, and in general, growth has slowed down. So I think that that's the typical pattern in any country, and that we see that they only carry out economic reforms under some pressure or when they have their back to the wall.
And investors have started to look elsewhere. Indian equities saw almost $21 billion of foreign inflows in 2023, but they plummeted to just $124 million last year. And investors have withdrawn more than $12 billion so far this year. So has something gone wrong with the India growth machine? And if so, where? Are we seeing a slowdown or just a blip? Ruchir Sharma is the chair of Rockefeller Capital Management and author, most recently, of The Rise and Fall of Nations.
Ever since I've been investing in this country for over 3 decades, which is that this is a country that consistently disappoints the optimists and the pessimists. Yet over the long term, it's a very good equity market story in particular, because even after the Indian stock market's big correction over the last few months, the only stock market in the world in the last 30 to 40 years, which has produced comparable returns to America, has been India. So it's this very steady compounding story. But yeah, there are times when people get a bit ahead of themselves, the excitement gets a bit too much. I think we may have reached that point last year when India became the most expensive equity market in the world, literally, even more expensive than America at the top. So that was just telling you that the excitement had got into a head, and what we've seen in the last few months is a bit of a reset where the optimists are getting a bit disappointed now after sort of thinking that maybe India can break out and grow at 7 to 8%. There's a realism setting in that India's trend growth rate is closer to 6% rather than 7 to 8%, a pretty decent growth rate, and that they still need to carry out some positive reform steps to even keep a 6% type growth rate going. So I think what we're seeing just now is a return to that old reality, so to speak, which has been the case for India for 30 to 40 years, that it's a country which steadily compounds, steadily grows.
But that might not be enough to reach Prime Minister Modi's target of making India a developed nation by 2047.
I think we're reverting to around the 6%. Now, the blip downwards recently has more to do with the fact that we had elections across the board last year, and spending on infrastructure, which has been a big part of the growth story, has sort of faltered over this period. I think that will come back. So we'll get back to 6. Now, the question for India is 6 enough? And unfortunately, the answer is not, because we're also a country that's growing old. And we do want to grow rich before we grow old, and that's unlikely at 6%.
The Indian government has stepped up efforts to re-energize growth, announcing tax cuts in its annual budget in an effort to boost middle-income spending. Raghuram Rajan is a former governor of the Reserve Bank of India and says the big problem for India is a lack of jobs.
We have a lot of young people. And as a result, the dependency ratio, the number of very young people who can't work and very old people who can't work, that's falling. And this is the time that every Asian economy has experienced a burst of growth. But if we're still growing at the old 6% and not enjoying that burst, something is not working as well as it should, and that's jobs. What you see around India is not enough young people have jobs, not enough jobs are being created. So in a sense, we're not making full use of our capacity, even at 6% growth.
Some foreign companies have seen potential in the growth of the Indian market as an alternative to China. Apple has been slowly growing iPhone production in the country, while more recently Tesla stepped up hiring in India ahead of a possible entry into the market. This so-called China Plus One strategy of India being a substitute for manufacturing in China may have worked in the past, but some question whether it will in the future.
What I have come to realize in the last 12 months is there is a strange realization with the Indian policymakers that they cannot sell themselves anymore as a China Plus One strategy. It has to be much beyond that.
Ritika Batra is Mahindra Group's Vice President of Americas and a senior fellow at the Atlantic Council.
Because if you look at it, the Indian consumer is not only inclined towards luxury and lifestyle products, unlike a lot of other emerging markets, but also has a very strong middle-class consumer base, which is also price conscious. So if you put these things together, where India is trying to sell itself as not just a China Plus One strategy, but an innovation and manufacturing hub with a skilled workforce, with a solid consumer base, and trying to differentiate itself with available worker versus available skilled workers, I think it's a great story to tell.
Whatever the theory, foreign investors have not always had an easy time investing in India. Just ask Volkswagen. They were hit with a record $1.4 billion tax bill from the Indian authorities for alleged tax evasion. And the German automaker raised questions about the very survival of its India unit.
Well, because I think it's still a very difficult place to do business on the ground, David. This is something which we have felt for a long period of time, that to negotiate the Indian landscape is tough, given the regulations that you still have in place, given the fact that you can have the tax authorities or other people come up and present bills to you in a way that you don't really know. A lot of the state chief ministers in India realize this, and I think this is something which we need to focus on, which is that a lot of the attention is on Modi, the center, and what Delhi is doing and what initiatives they're taking. But India is a very federal country, and you have so many state chief ministers with a lot of power to do what they have to do on the ground. And I think what we need to see in India, and we're seeing some signs of that, is much greater so-called competitive federalism, where the states compete with each other to get foreign investment, because a lot of these regulations and the tough environment it is to do business in India is something that some of these state chief ministers need to make friendlier, and not just the center.
Whatever direction it's going right now, what is the current state of competitive federalism when it comes to economics? Are there certain states that it's more conducive to invest into in India today than others?
Well, that's been the case in India for a while now, that if you look at India, about 20% of India's population is in the southern states. And yet those states account for more than 30% of India's GDP. And the per capita income is also a lot higher. Now, there are states in the south, such as Karnataka, which we know well because of Bangalore, which is the tech capital of India for all practical purposes. And what we see there is that places like Bangalore and Karnataka tend to attract much greater foreign investment. And generally, some of the southern states like Karnataka and Telangana and Tamil Nadu, those states have attracted much more foreign investment over time.
There is a historical reason for why South has managed to sort of lead from the front. And those reasons are the ports that are situated in southern area. They were the most important reason for traders to come to India to begin with. And that led to a huge amount of trading community moving and living in south of India. In the recent past, we see Infosys taking a lead in ensuring that they become the global service providers for technology. And that started in south of India in Bangalore. And one thing led to another where a huge amount of other tech companies started sort of launching based out of South India because of the skill availability of engineers in the southern part of India.
But even if India is moving to loosen restrictions on foreign investment, it is slow progress. And Rajan warns they might be focusing on the wrong sectors. Prime Minister Modi is pushing to grow the manufacturing sector. Does that make sense?
I think the days of growing manufacturing to get strong growth in jobs are over. I think it's as true of India as it is of the United States. And the reason is simply this, that increasingly manufacturing is becoming much more automated, much more dependent on machines. If you look at an assembly plant for cell phones in India, it's a sequence of machines, not a sequence of people sitting soldering stuff onto motherboards. So the kind of jobs that traditional sort of low-skilled manufacturing, assembly, electronics assembly, and so on generate, they're far fewer today. But there are other problems. Every country wants to expand its manufacturing and is growing protectionist against manufactured goods coming from somewhere else. So the space for manufacturing exports is also shrinking. India has other opportunities in services. It's been a giant in service exports in recent years. That's where it should focus its attentions more on.
Modi's push to build up India's own manufacturing base comes as President Trump looks to bring back economic activity within U.S. borders. It creates a dilemma. Both leaders talk up their relationship with one another. But can Modi's Made in India and Trump's America First be reconciled? And if not, which will prevail?
Every country is turning nationalist now. And everybody is also has a certain sense of manufacturing fetishism. They want their own manufacturing industries. And of course, this collides. I think the way to reduce this gap is by recognizing that each country has specialities and by working to ensure that there is more trade on those specialties. So, for example, lots of oil and natural gas being manufactured in the United States, India could buy more. There are defense products that are manufactured in the United States, India could buy more. So I think rather than seeing deficits, trade deficits as a problem, see it as part of a process of collaboration and just make sure that the playing field is level for both sides. I think that's something that can be worked on.
Coming up, luxury brands are looking to get their mojo back. But do we have too little of them or too much? That's next on Wall Street Week. This is a story about too much of a good thing. Every brand lives and breathes for exposure. But sometimes it can be too much. Luxury brands have reaped the benefits of consumers the world over seeking them out. But now the red carpet may be getting pulled out from under them. And my colleague Danny Berger tells us why it may be because they are too available to too many people in too many places.
Luxury, it's always going to be defined by some sort of form of desirability and some sort of form of exclusivity.
Luxury brands are mainly brands that sell something that is partly status, partly exclusivity and desirability, partly craftsmanship.
Well, luxury, has to be redefined. Luxury to me is having something that you love in your wardrobe forever.
Luxury brands are everywhere, from the bags we carry to the clothes we wear, down to the shoes we step into every day. But luxury brands are at a crossroad. LVMH, seen as a bellwether for the luxury sector, soared close to 250% between 2019 and 2024. But it's since fallen around 20% from the highs of last year, with a recent bounce offsetting some of those losses and leaving investors struggling to chart a path forward for the luxury brands.
When you look at economic profits of the luxury industry, It basically nearly tripled between 2019 and 2024. So it's really been amazing years. And I think at some point, everybody started believing this was the new normal and started to expect that this would continue. But as we all know, at some point, things stabilize or normalize.
Joelle Grunberg is partner at McKinsey, who leads the firm's apparel, fashion, and luxury sector in North America, and co-authors a yearly report on the state of luxury.
So as we know, in 2024, things slowed down in a significant way for the luxury industry. It has been a tale of different stories, in all fairness. Not all the brands, not all the corporations have suffered in the same way, and some are still doing great, in fact. But what we think is that 2025 will overall be a year of normalization. We obviously continue to see growth, but I would say in a more muted way. And it will also significantly depend on the region and the market. It would also depend on what category you mainly operate in. And it also depends, I would say, on, again, the situation of the brand overall, because some brands are doing much better than the others.
Hermès is one of those brands outperforming its luxury peers, but they are very much the outlier. Just last week, Hermès reported a jump in fourth quarter revenue, while LVMH and Kering posted declines. And Grunberg says there's a range of global headwinds challenging the luxury sector.
Two main factors contributed to the huge growth that we've seen since 2019. One first factor is clearly the rise of prices in luxury. Most of the brands have increased prices in a very significant way, more than double digits every year. And so that has contributed to 80% of the growth in revenue of these companies. The second factor is the pull of China. As we all know, the Chinese customer has been a very, very strong contributor to the growth of luxury globally. And so that, pull has been extremely strong and is slowing down right now. And what has happened in the past year and a half is that the aspirational luxury customer, and more specifically in the US, has been challenged because there's been a lot of people losing their jobs. And so therefore, they have been much more cautious and on pause. So part of the explanation is linked to that aspirational customer being a bit more on hold.
That perfect storm has resulted in some aspirational customers being priced out of the first-hand luxury market. We're very happy to receive them.
Maximilian Bittner is the CEO of Vestiaire Collective, a platform for pre-owned designer and luxury products founded in 2009, aimed at making fashion more sustainable. And a more strained consumer means the secondhand market is seeing significant growth, expected to reach $350 billion globally in 2028. That's up from $197 billion in 2023, with Vestiaire estimating 82% of its orders prevent a first-hand purchase.
We definitely do cater to the demand of the aspirational customer, as certain brands are more affordable, more accessible than they would be in a first-hand store. And I think we've especially seen this over the last 1 or 2 years, in a period of economic uncertainty, which in parallel has seen luxury brands increase prices, significantly over the last 4 or 5 years. When I joined Vestiaire at the end of 2018, early 2019, I recognized the incredible brand and community, but I also recognize the need for us to build a scalable, profitable business, for the next 20, 30, 40 years. Even the last 2 years, the business has proven extremely resilient, growing with more than 20% revenue growth. So the business has been, throughout the up and down cycles of pre-COVID, COVID, post-COVID, remained extremely resilient, which is great for us to see.
Parlez-vous Vestiaire Collective?
His formula for Vestiaire's resilience and growth, making pre-loved luxury more accessible to aspirational customers and vintage lovers.
The level of a spectrum goes from, your hardcore Hermès Brunello user to a more aspirational luxury brands, to more designer brands. I think overall our consumer base has stayed fairly stable over the last years. We've partly benefited from the aspirational customer maybe being slightly priced out by certain brands. On the other hand, some of our aspirational customers are buying slightly less than they were 2 years ago, but we see that slightly recovering now.
Vestiaire is not alone in riding the secondhand wave. The RealReal and Rebag offer similar services. And Rebag's reach got a lot bigger this year when it partnered with Walmart to sell its catalog of about 27,000 items on the retail giant's website. Targeting the aspirational customer, what might seem like a threat to luxury retail, in reality, could be a mutually beneficial relationship.
I think overall the mood and the attitude of luxury brands have dramatically improved over the last 5-6 years towards secondhand because, fundamentally we are not cannibalizing their sales. If anything, we pay homage to their brands by showing to the consumers, both the buyers and the sellers, how much value is retained in these products that they're buying firsthand.
Norma Kamali rose to the top of high-end fashion with the iconic sleeping bag coat that she designed in 1973. Since then, the New York-based designer has proven her ideas fresh and innovative time and time again. Like Bittner, Kamali sees the value of second-hand markets in luxury fashion.
I think anything that's a creative process, that's fun, is good for people. Right? And if in that secondhand you get a better price and you get a brand that you haven't been able to buy before, there's a whole cult of people who look for Norma Kamali vintage. And it's fascinating to me, but I see how great that is because in that generation, there's something I did when I was that age that is connecting with them.
Would you say Norma Kamali is also luxury?
Luxury to me is something that is accessible, affordable, and will last in your wardrobe forever. It can't be a purse that you spend $30,000 on and sort of collect in a closet with other purses.
How do you strike that balance then of being both accessible but not oversaturated in the market?
It's an important thing to do, and I think, first of all, knowing your distribution, being careful about the distribution, make sure the distribution is to your customer, the person who connects with you. And we have a global distribution, and we could still be reaching many, many more people.
There's no question that more consumers are exposed to and have access to luxury than ever before. But at least one icon of the industry admits that change is inevitable. We started this conversation with this idea of luxury doesn't mean exclusivity. Do you think some of those secondhand apps are also changing the conversation in that regard?
Oh, totally. I think the fashion industry clearly is going through a huge, huge change. And it's long overdue. It really is. And I think when an industry can have a lot of variety and a lot of choices and a lot of price ranges, then it's healthy.
Healthy for the consumer, but a challenge for the luxury brands to overcome as they look to rediscover the growth of the last 5 years.
Coming up, President Trump promises growth and prosperity through deregulation. We get two different perspectives from Jeff Myron of the Cato Institute and Catherine Judge of Columbia. That is next on Wall Street Week. This is a story about unintended consequences. Sometimes even the best-intentioned government regulations can do more harm than good. But then again, cutting back on regulation can also do real mischief.
We did the right thing. That was a very important thing to get rid of. And it was also a waste. I mean, number one, it was a bad group of people running it.
If the CFPB is not there examining these giant banks to make sure they are following the laws on not cheating consumers, who is doing that job?
I can say no other federal regulator.
So which is it? Is government regulation holding the U.S. economy back? Or is it an important foundation for much of the economic benefits we've reaped? And if it can be both, how can we tell the difference? Jeff Myron is Director of Undergraduate Economics at Harvard and the Director of Economic Studies at the Cato Institute.
I don't think there is a definitive study on productivity and regulation. There are many studies of individual industries, of specific time periods, of special cases, but those are all relatively small pieces of information. Finding an overall clear assessment is pretty hard. I think many people would point to key environmental regulation in the United States, the Clean Air and Water Acts, as having been quite successful. But even those are not without some degree of controversy. One certainly finds that as a result of those acts, which were passed in the early 1970s, air got cleaner, water got cleaner. But if you then go the next step and say, were those improvements worth the extra cost? Because of course, putting restrictions on what firms do and what cars can do raises the cost. And there the assessment is still probably beneficial overall, but not so obviously, not so dramatically. So even for one of the relatively clear successes, I'd say there's still some room for reasonable people to disagree about how effective they were.
Myron has harsher criticism of food and drug regulation, where there has been mission creep, delays, and political and legal tangles.
So the very first major attempt, federal attempt, to deal with dangers of drugs and food was called the Pure Food and Drug Act of 1903. And it did something very mild. It said that medicines and food substances had to include a list of the ingredients on a label on the outside of the package. That's pretty innocuous. Even if you're a hardcore libertarian, it'd be hard to get too exercised about that. But that notion that the government was going to protect people from dangerous products evolved into creating the Food and Drug Administration in 1938, which then had the power to keep things from being on the market at all. That's a much higher bar. Now we have the current system, which involves years of delay, sometimes billions of dollars in testing before things can go on the market, and that probably prevents some bad drugs from ending up on the market, but also delays all of the good drugs from getting on the market. The goal of the Food and Drug Administration is to prevent medicines from entering the market that might have unusual side effects that weren't discovered when the drug was being created, that might not work nearly as effectively as claimed, and things like that. So just protect people, to improve people's health. And yet the process of requiring all the trials, and checks and balances before a drug is released to be used mean that people who are suffering from the condition for which the drug is supposed to be useful face delay. They may die before they ever get a chance to use the drug. I think a lot of economists would say the evidence on the FDA is not very strong, that it may well be doing all sorts of damage by preventing good drugs from getting on the market earlier. And then there's the scope, as with other kinds of regulation, for completely unpredictable unintended consequences that are very different than what people were thinking about when they created the system.
One of the first agencies targeted by the new Trump administration is the Consumer Financial Protection Bureau, a brainchild of Democratic Senator Elizabeth Warren of Massachusetts in the wake of the great financial crisis. Professor Myron sees it as a typical example of regulation coming after the fact with unintended consequences. Catherine Judge specializes in regulatory architecture and banking at Columbia Law School.
The regulatory structure when it comes to financial regulation is an absolute mess. I don't think anybody would disagree with that. We have the CFTC and the SEC as two different market regulators. We have three different banking regulators overseeing banks. So I think there's a lot to be said for saying, let's look at the overall regulatory regime and let's come up with a blueprint that significantly simplifies that regime. We've had a bunch of executive reports, the Volcker report that really tried to say, here's how we can have a more rational and more systematic regulatory regime. That's not what we're seeing right now, but there's a lot to be said for moving in that direction.
We have a new Trump administration, and it is dedicated, among other things, to deregulation. One of the first places it's focused is the CFPB. Tell us about whether they have a point that maybe the government went too far in regulating the banks in the CFPB.
I mean, there's some really interesting questions there. So one of the key things to note about the CFPB is that a lot of what it was trying to do was just level the playing field between banks and non-banks. So banks long had obligations to engage in fair lending and to provide truth in connection with their lending activities. And a lot of what the CFPB did said, we have this really robust system of oversight and enforcement for banks, but we have all these non-banks. Let's make sure we have a more even playing field, and then let's create a separate regulator. So that way they have to kind of all do these things together. But one of the important things to note is it didn't create new law. What it really did was just change the supervisory mechanism and the enforcement mechanism around existing laws. And so there's a lot to be said for questioning kind of what is the optimal level of regulation, what is the optimal level of enforcement, but then you actually have to get the substantive law rather than this kind of structure through which it's actually enforced.
There have been consumer protection laws in the states for many, many years. If the CFPB were to go away, could the states step in a federal system and do some of what we need the CFPB to do?
So the states are certainly going to step in. They can play a very important role in this domain. They're not a perfect substitute, and actually it makes it very difficult for regulated entities because suddenly you're having to look at a lot of different states. So one of the things that's really important to note if you're a regulated entity is right now you might be really frustrated with the underlying rules, and you might look at the CFPB as a face of the body that's implementing those rules. But you're not going to get out of any of those rules or legal obligations. You're not going to be able to avoid the possibility of enforcement. It's just going to come from a different source.
Talking about regulating the banks, and the non-banks for that matter, right now, beyond the CFPB, you are an expert in this area. Are there places that we could make sensible reforms? You said the system overall is a mess.
There's a lot of ways we could make very, very sensible reforms. And I think we could make sensible reforms in terms of structure. There's also a lot of sensible reforms that we could make in terms of the nature of the actual regulatory burdens. We have a tendency with both structures and burdens to be additive, just layer a bunch of things on top of each other and not think holistically about how they all fit together. So I think that there's a very welcome place to try to rationalize the structure of financial regulation, reduce the number of financial regulators we have.
Anyone who's ever been regulated doesn't find it a pleasant experience necessarily. At the same time, the claim is that overregulation is holding back the U.S. economy, that we are less competitive, we have less productivity. Is there any basis for that in the research and the studies?
I mean, there are certainly some areas where you have to be worried about the level of regulation, but it's also important to realize that regulation is very often what promotes innovation, what promotes credibility, and what promotes trust. So if you think about a body like the SEC, for example, they play a really critical role helping to promote capital formation.
You mentioned two things, trust and certainty. What are the risks of just confusion and uncertainty actually holding back the economy?
It's one of the really big risks right now. So I think a lot of the story that we're hearing are the ways that regulatory burdens have really limited economic activity. So if we reduce those burdens, we're going to get more economic activity. But what we've seen so far doesn't actually change regulatory burdens. There's a lot of ways you can do it. If you're an agency and you have rules in place, you can go through a rulemaking process to change those rules, to reduce the burdens. You can go to Congress, have them change the rules. Right now, a lot of what they've done is to gut the capacity to enforce the existing rules, but that too can change really quickly.
In your mind, what's a good example of where regulation really worked and was successful?
I think it's worked in a whole variety of areas. I mean, I think overall the banking system is much healthier and more stable as a result of regulation than before we had the regulatory system that we do. It's far from perfect, and there's room for ongoing improvement. But before we had the Federal Reserve and the other banking regulators and the system that we have, the United States had far more frequent banking crises than a lot of our other peers that had central banks. And so we started to say, look, we actually need a central bank. If the central bank is going to help provide liquidity and provide support, if the FDIC is going to provide deposit insurance, we also need regulation. And it's an overall system that has broken multiple times, but most people still have faith that if they put money in the bank, they can get it out. And so I think we want to protect that trust and protect the functioning of the economy where it works well, and then try to figure out how do we do that.
What's an example in your mind of where regulation really went wrong?
That's a really good question. I was going to say, because there's so many, but oftentimes they're not in finance. I mean, I think oftentimes where regulation really goes wrong in finance is when it creates different burdens on the same activity across different domains. So one of the things that we've really found often is if you regulate really aggressively in one area and all the activity migrates elsewhere, it's not going to work well.
But as Bank of America's Brian Moynihan told David Rubenstein, it's not really about how much regulation, but about making sure it's the right kind.
So at the end of the day, it's about getting these regulations right. And I think it opens a dialogue about how to get these regulations correct.
Coming up, they are called zombie companies for a reason. There are more companies who don't make enough to pay their bills than you might think. But we bring you the story of one of them that came back from the dead, Barnes & Noble. That's next on Wall Street Week. This is a story about the corporate living dead, companies that don't make enough money to cover their debt year after year, many of them ultimately giving up the ghost.
End of an era for retail giant Bed Bath & Beyond.
We have breaking news. The party's over for
Discount retailer Big Lots is closing all of its stores nationwide.
The annals of business are full of stories of companies that fought the good fight, but ultimately lost. The number of business bankruptcies in the United States is on the rise, up over 70% in the past 2 years. And corporate delinquency rates are the highest they've been in 8 years. Bankruptcy usually is the end of life, at least in the company's current form. But maybe you've noticed that some stick around, and there's a term for them: zombie companies.
A zombie company, it's fundamentally a financially unsustainable company. These are companies that are not producing enough operating profit to pay the interest on their loans. And they've been in that position for at least 3 consecutive years. So when we talk about a zombie, it's not a company that had a bad year or a startup or anything like that. We're talking about sustained material underperformance. These are publicly traded companies that have been in business for at least 10 years, that have revenue for each of those 10 years. These are real companies that are having profound financial issues.
Vincenzo Spazzato is a partner at Carney, writing a yearly report on zombie companies and their effect on the health of the overall economy. You study these zombie companies. How many are there?
Just looking back to put this in perspective, in 2010, there were under 2% of publicly traded companies globally. We've seen around 10% annual growth since then. And so we're up to around 6% of all publicly traded companies globally. 6 out of 100 are currently zombies. So we're talking about a not insignificant number of companies. It's sort of all industries, all company sizes, they're sort of everywhere.
In 2023 alone, Carney identified 827 new zombie companies, taking the total number to almost 2,500 globally, with real estate and manufacturing leading the way.
A lot of zombies are companies that should not have gotten financing to begin with. Given the sort of easy access to capital that we saw coming out of 2008 and the financial crisis, and those are companies that are going to be very difficult to turn around.
Normally we'd think those companies get weeded out.
You would think so, and yet a lot of times they'll carry that interest forward. The interest payable is a loss. Capital markets are incredibly rewarding and have been very forgiving recently, particularly coming out of the financial crisis. There's been just real easy access to financing to a lot of companies that one may argue shouldn't have actually received that financing at such low interest rates that they were able to sort of kick the can on the issue and move things forward. So a lot of zombies have in fact stayed in business for a long time. Many of them do ultimately they either go bankrupt, they get acquired, or every once in a while they're able to turn themselves around.
One of those so-called zombie companies that's come back from the dead is the well-known bookseller Barnes & Noble. Back in 2010, it teetered on the brink, closing hundreds of stores and laying off thousands of workers. And then in 2018 became a full-blown zombie.
We've definitely seen an increase in the number of people coming through the door. That sense of discovery, it's a different experience, to go from table to table or bay to bay and find something new.
I think people have attachments to like their neighborhood or their corner books, or even if it's like a larger company like this, it feels warm to be able to come to an actual location and do exploration in person.
I think there was a number of things that went on. Amazon came and that took a chunk of the easy sales, disappeared. A fear that people were no longer going to read physical books, they were just going to read ebooks, Kindle, Nook, and all of that. As people lost confidence in books, they then started selling other things, which then compromised the ability to present really good bookstores. Publishers panicked, booksellers panicked, everybody panicked. And I think when you lose your compass, then you go off in really in the wrong direction. And it was a fundamental loss of confidence, and it happened not just in the United States, it happened pretty much worldwide. And most large bookselling chains got themselves into big trouble.
Elliott Management stepped in with a $683 million takeover and appointed James Daunt as CEO, and the resurrection began. Since 2019, foot traffic has increased 7% at Barnes & Noble, and the company has opened 113 stores across the United States, with another 60 due to open this year. When you came in, what did you do? I mean, what were your priorities? What did you focus on first?
One can't sort of dodge around this in any euphemistic way. We had to cut costs, and that meant reducing dramatically the head office structures. Helpfully, my other sort of core principle was to allow the booksellers in each store to get to grips with and start working on their bookstores. Now, if you do that, you need far less central direction because you're letting the guys in the stores do the work. So we were able to reduce our costs substantially, and then turn to the individual bookstore teams and say, sort out your stores. And we just started to sort of preach that message and put a few practical steps in place when COVID came along. So we then had a pandemic when all our stores closed. Turns out to have been actually a huge stroke of fortune.
Why was it a huge stroke of fortune?
What we really needed to do was work on the stores. And that's quite difficult to do if you're still also running your store. It's full of customers. Suddenly we were literally having to close our doors, but we kept the lights on, we kept the people in the stores, so we kept our experienced booksellers, and they worked through the pandemic inside the stores, moving the furniture around, going through all the books. By the time we were allowed to open again, we had much better bookstores, just through moving, changing, getting rid of the books that shouldn't be there, presenting better. Lo and behold, during COVID, lots of people discovered reading and the joys of reading, and we opened to that re-energized customer base who are coming back onto high streets with much better bookstores.
The story of Barnes & Noble is obviously a very famous one. It's a very popular one. And I think they went back to the basics. They looked fundamentally at what customers were looking for. They looked at what worked. And they spent the time focusing on the areas that were impactful. The strategy, understanding your customers, restructuring your supply chain, building resiliency in your supply chain precisely to preempt some of that disruption that I mentioned. Those are all sort of important factors to building a resilient company that, when sort of financing is structured the right way, can in fact get them out of zombie status.
Those keys to success, understanding customers and individualizing stores, was something Daunt brought with him from his experience owning his own independent bookstore in London, and then applied as the recipe for success to restore and reinvigorate the Barnes & Noble brand.
I have the firm belief that if you leave it to the bookstore team, and it is a team, they will put the best possible bookstore in front of you. It is all about recommending the books to the community that you know and understand. What we've benefited from is because we relaxed and because we've let the store teams do pretty much whatever they want, trusted in their common sense, trusted in, and we have a vocational group of booksellers out there. They love books and they love talking about books, they love selling books, and they also love getting on social media and being quite fun and foolish about books. And fun and foolish turns out to be absolutely what you need to be doing. So a lot of our success has come from us being actually at the forefront of things like book talk. And that's our booksellers. As I always say, give it to the one with the blue hair and leave them alone. It's going to go well. You know, you don't need people with grey hair looking like me running your social media. And that's when you're trying to control things. That tends to be what it is, when you just let them get on with it.
Miss, you forgot something.
Thank you.
Now, we will have the odd sort of foolishness, and again, let's not overreact. We know that fundamentally our booksellers are hugely motivated in everything they do. Support them, encourage them, and when they make a really mistake, just get them back into line.
So if not all zombie companies are headed toward failure, if some, like Barnes & Noble, can not only come back, but come back strong, how can we tell which ones are worth the effort and which ones are better off put out of their misery?
If we compare zombie companies to recovered, one of the first things that we see is that there are differences with respect to leverage. So leverage ratio, but also total assets. We see that those are one of the first characteristics that change when a company is in the recovery zone versus in the zombie status. When we look at other factors in terms of zombies that recover from the zombie status, there are also other characteristics that play a role, not only leverage and total assets, but also, for example, how they use cash, for example, how they use equity, taxes, working capital, and other characteristics.
Angela DeMartis is an economist who studies zombie companies globally, using machine learning to identify zombies and detect patterns in which survive and which do not.
What we find is that the share of zombie companies in the United States is much lower compared to zombie companies in Europe. So their prevalence is way higher in Europe and also emerging countries. And this is mostly related to, for example, differences in the characteristics of these companies. So we always look at listed firms. And we see differences between the United States and Europe with respect to, for example, their financial structure, but also the capital structure of the company, and also what plays a role is differences with respect to the institutions. And so this might also explain why we see a much lower share of zombie companies in the United States with respect to other European countries in which the phenomenon is way more prevalent.
Could a factor be the different ways that companies finance themselves in the United States versus Europe? My understanding is banks play a much larger role as opposed to capital markets in the United States.
Exactly. Yeah, this is one of the things that we argue is one of the main points and one of the main differences that we see. So in one of the studies, what we do is we look at listed firms in the United States and in Europe, and we use machine learning methods to sort of develop an early warning system that is able to identify zombie companies and also separate them from the non-zombies and also from the recovered. And so at the firm level, for example, we see that beyond leverage and total assets, there's other characteristics that do play a role, like, for example, working capital, for example, taxes, for example, shareholders' equity. And we do see differences between the United States and Europe that go back to, for example, differences with respect to capital markets, with respect to the financial structure of the company, and also with respect to institutions.
Back in the United States, James Daunt sees only one true threat to his Barnes & Noble falling back into its former zombie status.
For a large bookseller, the only thing that we can really trip up on is if we lose our confidence. That's what happened before, and hopefully it won't happen again. But if it did, if you lose your confidence and you stop being a really good bookstore, then people stop coming to you.
Up next, Larry Summers' advice on what really matters in the flurry of initiatives coming from the new Trump administration. From cutting the government to deporting undocumented immigrants to trying to annex Greenland, there's a deluge of announcements and policy changes coming out of the new administration. Special Wall Street Week contributor Larry Summers has strong views about what is most important.
I think there are two questions that historians will remember from what happens in the next months. The first is what happens to the international order. Neville Chamberlain and appeasement come to mind. There's one important difference. Neville Chamberlain appeased Hitler. He did not side with those who were conquering innocent countries. President Trump has given evidence of a willingness to side with Putin against a free and independent Ukraine, with consequences that go far beyond Ukraine to American credibility, to the way America's allies view it, to the approach they take to their own defense, including nuclearization. It goes to what our potential adversaries think will be possible. And because it raises questions, because once you break a promise once, there's always the possibility that you will do it again. It is irreversible in a way that budget cuts or stopping programs or interfering with the normal functioning of government, that stuff is much more reversible than what you do to the international security order. Nobody remembers Neville Chamberlain's budgets or the Neville Chamberlain's governance domestically of Britain. Everybody remembers what he did in the foreign policy and security arena. And that's why the security arena is so profoundly consequential, and what's being done with respect to Ukraine seems to me to be so worrisome. And we haven't really seen the answer. Past U.S. presidents for the last century have pushed the edges of their authority, have tried to govern boldly and strongly and to assert executive powers. Their actions have been challenged in court, and when courts, ultimately up to the Supreme Court, have ruled against those presidents have backed down. Even Richard Nixon backed down on impoundment, backed down on turning over the tapes, respected the rule of law as it was declared by courts. There is rhetoric that has come out of the Trump administration suggesting that that will not be their approach. There have not been decisions made that flaunt courts in an unambiguous way. As long as the administration responds to court orders, there will be steps taken with which I'll profoundly disagree. There'll be steps taken that many think are grave mistakes, but the fundamental traditions of American governance will continue. If, however, there is a position taken of flaunting courts, then we're in a very different and unprecedented place in which the rule of law and constitutional democracy have been called into question. And so there are 100 questions, but only 2 profoundly important questions. Will the administration respect the rule of law as determined by the independent American judiciary? Will the administration stand by America's fundamental commitments in treaties and beyond to other nations? Those are the questions that historians will be writing about decades from now. Much of the rest, cutbacks in this budget, firings of these employees, are profoundly important, but I don't believe they'll be in history books in quite the same way.
Larry, there's no question that the rule of law and also the U.S. living up to its international obligations is profoundly important, as you say. But draw the connection to the economy, to the markets, if in fact that goes the wrong way.
Look, Treasury debt is nothing more or less than a government promise to pay the bondholders. A government that doesn't believe in adhering to promises and adhering to contracts and respecting judicial government and judicial orders is not a government that can be trusted. And so the sanctity of our debt is called into question by default on any obligation. That's why lawlessness is so financially significant. There's another way of looking at this, David, which is that American assets carry higher multiples than assets in other parts of the world. That's why our stock market, why the value of American companies is now nearly 2/3 of the value of all the companies globally. Part of it is higher earnings, but much of it is a higher multiple. That multiple, in part, has to do with growth prospects, but it also has to do with certainty and confidence. And when you erode that certainty and confidence, you erode the rule of law, and you erode potentially those multiples. So I think that what is happening is potentially very threatening. You know, we had a period in the early 1970s when there were similar efforts to shock the system. The sudden imposition of unilateral tariffs against all other countries in the world, the sudden devaluation of the dollar, the sudden imposition of wage price controls. It may well be that rhetoric that is pro-business, that is applauded by business leaders, will support optimism and support buying in a way that allows markets to rise. But I think ultimately the foundation of our remarkable prosperity in the United States is not around confidence in any single authority, but is in confidence in a system. And if the credibility of that system is undermined, I have very little doubt that in the medium and long run, it will be very costly to investors and citizens alike.
That does it for us here at Wall Street Week. I'm David Weston. This is Bloomberg. See you next week for more stories of capitalism.